Not having to worry about share price drops when the markets decline is undoubtedly one of the best things about investing in dividends. In fact, it presents an even better opportunity, especially for those of us who prefer to invest for income over share price performance. Since practically everything is currently discounted as a result of the markets being in the red this year, there are many fantastic possibilities for investors who prefer higher-yielding investments. Whether you like to invest for growth or for income, due to the dramatic price decreases in the equities we invest in, we can purchase more shares of those stocks, resulting in bigger dividend payouts. With a $500 investment, we would be able to purchase a few extra shares of a dividend stock, boosting our dividend payouts each month or quarter. Two firms in particular this year offered a really strong opportunity to invest, both of which are currently paying yields of over 9%, with one just last week raising dividend payments. Additionally, these stocks pay dividends on a regular basis and have a lengthy history of reliable dividend growth. These equities were only yielding around 5%, which didn't particularly catch my interest. But due to the market decline in 2022, which caused these stocks' share values to drop by more than 25%, they are now providing investors with hospitable yields of over 9%. So let's examine these stocks closely to determine how they have managed to do so well over the years and where they are headed, maybe moving forward. Gladstone Investment, a business development firm that specializes in lower middle market mature stage buyouts, is the first stock I'm referring to. Its symbol is GAIN. They make investments in the industries that produce consumer goods as well as in commerce and consumer services. Gladstone Investment typically makes debt investments between $5 and $30 million, and equity investments between $10 and $40 million in small and medium-sized American businesses. Companies prefer to hold investments for about 7 years before selling them, raising further funds, or going public. They were established back in 2005, making them one of the more established business development firms that are still publicly traded. Gladstone Commercial, ticker GOOD, is a real estate investment trust that has focused on purchasing, owning, and operating net lease industrial and office properties across the United States since 2003. They are the second monthly dividend stock. With a specialization on industrial products, this organization has been concentrating on single-tenant and anchor multi-tenant net lease assets. About 17 million feet of mostly industrial and office real estate are owned by Gladstone Commercial, which focuses its investment efforts on credit. Targeting middle market and investment-grade firms' mission-critical facilities is another area where they place a growth market emphasis. They also have a second BDC called Gladstone Capital, ticker GLAD, which instead of acquiring companies like Gladstone Investment, they choose to partner with businesses to provide financing solutions for expansion. Gladstone Investment and Gladstone Commercial are just two of the 4 publicly listed businesses that fall under the Gladstone umbrella. Another real estate investment trust that owns farmland and other properties linked to farming and leases them to farmers is Gladstone Land, ticker LAND. Farmland Partners is the other one of the 2 farmland REITs that are now in existence, but it's great that all 4 of these businesses pay monthly dividends. Gladstone Capital has experienced a few dividend reductions since the financial crisis ended because of the pandemic, but they have subsequently been able to grow it back to its original level. Their Farmland REIT does offer dividend growth every quarter, but it's so negligible that they only raise it by a fraction of a penny, and it currently only yields 2.84, which really doesn't make me interested. It might be a good holding for the sake of diversification. Despite the fact that their dividends haven't increased in more than 10 years, I still think it's a good choice. There isn't really an easier way to invest in farmland if you really want to do it. But if you do decide to do a deep analysis on it, you'll also need to consider a lot of other factors like the climate and crop prices. Gladstone Investment is one of the few business development companies that has seen significant growth over the years. Many BDCs don't grow much at all. Penn and part floating rate capital and Triple Point Venture Growth are two instances. Despite this, they continue to pay a reliable 8 to 10% dividend return. Ares Capital and Main Street Capital are two good instances of BDCs that have delivered good growth over the years. Despite the fact that they are now out of the financial crisis, these stocks' dividends continue to grow consistently. These dividend increases can be attributed to their rising book value, which is, in my opinion, the most crucial metric when analyzing any business development company, because BDCs invest in companies whose growing book value shows that they're making good investment decisions to increase their portfolio of debt. They have increased their dividends 8 times in the past 10 years. Let me know in the comments if you have any other questions about investing. Let's return to the video. A BDC will be able to pay shareholders more dividends if their debt portfolio is greater, because they will be able to charge more interest on their loans. This company does hold more equity investments than first lien debt, which might make things riskier since equity debt has a lower priority for repayment. However, if the company makes wise investment decisions, having more equity investments can also mean more development. This is another BDC that retains a lot more equity investments, similar to Gladstone Investment, and they have been able to give investors growth over the years, similar to what Main Street Capital does. However, as you can see, AI Rock Capital hasn't been able to increase its dividend by investing in more equity holdings. Other BDCs like AI Rock Capital hold almost exclusively first lien debt, which can make things safer if their borrowers default. Gladstone Investment has been doing such a good job considering they have been operating since 2005, which makes them a pretty old BDC that is still publicly listed. But Gladstone Investment is different from most other BDCs for another reason. If chosen well, business development companies can either grow their portfolio or shrink it faster. Most BDCs offer financing options to firms, so they may develop and expand. And occasionally, they offer funding so companies can restructure their way out of a difficult situation. Contrarily, Gladstone Investment really buys the firms. However, they hold on to them for a while before selling them off through a recapitalization or having the company conduct its own initial public offering. This company has been successful using a different approach than other BDCs since its founding. And as I indicated earlier, its monthly dividend was just boosted from 7.5 cents per month to presently 8 cents a month. This company also disclosed that on December 15th, shareholders will receive a special dividend of 12 cents per share, which will serve as a great bonus just in time for the holidays. In light of this year, it is clear that this company has continued to perform well, and considering the recent dividend hike, management has been doing a fantastic job of managing the business. The other monthly dividend stock is Gladstone Commercial, which buys, holds, and manages net leased office and industrial buildings. If you've been following my channel for a while, you might be aware that there are several REITs that I simply don't have any interest in purchasing because they frequently perform horribly when the economy is struggling. For instance, even though there is money to be earned from owning hotels during prosperous economic times, I have never owned any and I highly doubt that I ever will. The same is true for what I would refer to as experiential REITs, which are REITs that own things like golf courses, ski resorts, and water parks. When we enter recessions, they tend to struggle greatly because fewer people take vacations. One of such businesses with a monthly dividend and a high yield of 8% is EPR Properties. Analysts have been predicting for months that this reading will soar in the next few years, which it may do. But the truth is that there are plenty of other sectors of the stock that are worth investing in. People won't be visiting water parks and ski resorts as frequently if there is a big recession. But I've never been a fan of office REITs, which is what the Gladstone Commercial bills itself as. Consequently, if you're wondering why I own shares of this company, it's because it owns both office and industrial buildings. In fact, it owns more industrial than office assets. I also have a little amount invested in Stag Industrial, another industrial route that pays monthly dividends and has demonstrated consistent development over time. Currently, this corporation is the owner of 136 properties with a 97.3% occupancy rate. It's important to note that this rate has never seen an occupancy rate below 95% throughout its history. It has fully recovered from the flu pandemic and is currently receiving 100% of its rent. Thus, it hasn't reduced or lowered its dividend in any way. In reality, this company hasn't cut its dividend since going public, and their weighted average lease duration is a respectable 7.1 years. A longer wait is preferable because you want to tie in tenants into long-term contracts in order to better predict future rent payments. I'd say it's on the lower end relative to other rates like WP Carey. You can see that Gladstone Commercial has expanded over the years. Since December 2010, they have increased the number of properties they own and the number of tenants they are able to lease, and occupancy has remained stable, which in my opinion further attests to how well the management of this business has been performing. Only 2 assets out of the more than 100 with over $1 billion invested since the company's foundation have ever defaulted. Since Gladstone Commercial focuses on secondary growth markets, which they claim allow for significantly greater yields, the majority of their properties are situated in the Southeast and the Midwest. According to their financial indicators, this company has consistently increased both their total revenue and their total gross assets year over year. However, money from operations per share has essentially been static for a number of years, which helps to explain why this company's dividend growth has lagged behind Gladstone's. A measure exclusive to rates, investment funds from operations is comparable to profits per share for other dividend stocks. Since rates own and manage real estate, you shouldn't use EPS for them because it doesn't take depreciation or amortization into account. Despite how tumultuous this year has been, everything has been pretty constant for this company, even though this is a really significant portion of their financials. Even better is the fact that both businesses have a track record of providing supplemental or extra dividends. In addition to usual distributions provided to shareholders on a quarterly or monthly basis, these are one-time dividend payments. Since they are one-time events, you can't plan for these types of payments. Although Gladstone Investment and Gladstone Commercial have historically paid more of these special dividends to shareholders than the other firms controlled by Gladstone Investment. However, if a severe recession does occur, these special dividends may begin to slow down. You might be wondering why I don't have much affection for the other 2 Gladstone corporations. Well, Gladstone Land has a dividend yield that is simply too low for me to be concerned about it. I think Gladstone Capital, ticker HAPPY, is a good choice, especially given that it's paying a much higher return. But I simply feel that this BDC is inferior to their other BDC. Gladstone Capital has had greater dividend reductions than Gladstone Investment, and GAIN has continuously increased and paid out more dividends to shareholders. Alternatively, Happy pays the same dividend amount as they did in 2009. Personally, I would stay with just adding more Main Street Capital shares to your portfolio if you want to add another monthly BDC. It currently has a lower yield, but offers growth if that's what you're looking for. Although I ultimately believe that all 4 stocks are good investments, Gladstone Investment and Gladstone Commercial remain my personal favorites. They have a history of providing reliable returns and never missing a dividend payment. Additionally, both firms' financial positions appear to be strong from what I can tell. But as always, do your own research and reach your own judgment before investing in either of these businesses. Always comprehend how the business you're investing in makes money, so you can choose how each business can distribute profits to shareholders. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.